that we saw on the balance sheet. So meaning we owe this supplier an amount of 225 for this particular transaction, supply that we took from him or from that particular supplier. Yeah, sure. So this is how it looks like. You can see the age payable is duly credited, and that's exactly what we saw in the balance sheet. Now we have confirmed the inventory valuation. Now we have the 225 sitting here, and we have correspondingly our liability account also is carrying that particular value. So this means that our transaction is intact. And if you go to your inventory and you check the inventory valuation report, you should have that same value of 745 in the name of this particular supplier, and then the items that we have in our stock. Yeah, so this is literally how it's supposed to be. Okay, having done this, let's go back, and then now we are done with the pitches. We have received it. So the next thing to do in finance is to pay the supplier, either by bank or something. So that will be taken care of, I think, at a later stage, or depending on the payment terms. Depending on the payment terms, you will be able to pay this particular bill number 6 as it is. So you can pay it off, supposing the payment to go through maybe bank or something. You just have to create the payment, and that is it. And there you go, the payment is done. Yeah. Now, that's the first leg of the transaction that we are seeing here. So as per our scope optimization, you can see that before billing, this was what happened. Now, during the billing processes, we debited the interim receipt account to make it 0. And then correspondingly, we credit the account or payable or the liability account as we have seen in the age payable and then the balance sheet. So now the credit account amount is sitting in this particular account in the name of the supplier. Okay, that's exactly what we have done. The next leg of transaction is the delivery aspect, invoicing. You will admit that when we started the discussion, we mentioned that there are two legs for this particular transaction. One one of the gateways is the receipt concept, that is from procurement to payment. Now, the other leg or other process activity has to do with sales. So you now have the stock of goods, and you have the option to now sell to your potential customers. So we are done with the procurement to P2P, procurement to payment. Now we have to sell that same goods to our customers, potential customers, and then see what happens in our balance sheet or in respect of the interim delivered account that we saw. So literally, under product categories and the chemical inventory, we saw what happened between interim receipt account and then the stock valuation account. Now this is 0, and so we have our stock value as per the stock that we kind of procured from the supplier. Now, we need to see what happens to the interim delivered. And that's exactly what we are seeing here. At the delivery point, that is before invoicing, we are expected to credit the inventory valuation account. Like we mentioned, it's an asset account. So by default, it has a debit balance. It increases by way of debiting. If you credit it, you are reducing it. And that's exactly what we need to do to reduce it. So before you invoice, or at the point of the invoice, this is what is supposed to happen to your GL account. Okay, so we are going to credit the inventory valuation account to reduce it, and then debit the interim delivered account, which is supposed to be our clearing account. So it is an intermediary account between the valuation account and then the accounts receivable. That will give us an option to credit our revenue whilst we are debiting the accounts receivable in the name of that particular customer. We will see that that flow. So this is what we are looking at, or this is the point we have gotten to. So let's go and create some sales and see what happens. So let's go to the sales model. let's create a sale to this particular, let's say, customer, international customer. Okay, so let's give it to this particular customer. Let's say mag 101. We have 100. Let's sell all the 100 at a unit price of, let's say, 75.5. Now we have 7,550. We'll confirm this, and a smart pattern is generated for delivery. So this is exactly what we are saying, that before invoicing, this is what happens. It means that if we go to our balance sheet, we are expected to see some corresponding transactions in the balance sheet or something like that. So let's see what happens in our balance sheet at this moment. Come to current asset. Okay, let's proceed with the delivery and validate the delivery. And then refresh this finance. So you can see that the interim delivered account has been updated. The interim delivered account has been updated. Now we have created a delivery and we have indicated or confirmed uh, the movement of the stock from our warehouse to customer location. So this is the update and this is how it's going to look like. We can proceed to generate our invoice. So as we are saying, before invoicing, the inventory valuation account is credited. So you can see that in the balance sheet, the valuation account is reduced. It's reduced, and then by way of uh, credited and debited to the finished goods or interim delivered account. This account is expected to be correspondingly credited and then to be debited against the receivables, accounts receivable. That's the next step to do. That is when we invoice. So exactly at this point. Now, the next point is during invoicing. What happens? Let's take a look at what happens during invoicing. So during invoicing, let's come to sales and generate the invoice out of it. And then we confirm this invoice, refresh the balance sheet, and we can see that the valuation account is still maintained at 520, meaning we have taken the initial update of 225 out of it. The goods interim delivered account is now zero. What it simply means is that our receivables account um, has been updated in the name of the customer. Receivables, yes. So if we come to receivables, we should be able to see that particular transaction sitting here, meaning we have successfully credited the interim delivered account. We have credited it, and then we are correspondingly debiting the accounts receivable. That's literally or exactly what is happening here. So if we go into it and go to our general items, we can see that our trade, what's the name? Our sales account or revenue account is credited, and our trade receivables is debited. Perfect. Meaning if we come to our age receivable, the national customer, you can see the transaction sitting here. Perfect. Now we can proceed to take a look at our balance sheet once again. And there you go, everything is intact. And so after the payment or collection of this particular amount, the trade receivables account will be correspondingly what's the name? Uh, Credited, and then our bank is debited. Okay, so let's assume now we have the invoice. Let's create the payment. So we need to create a payment, and let's go to bank. To debit bank with this, just as to clear the accounts receivable. So let's indicate this. Now payment is done. If we go to our balance sheet and we now go to our age receivable, is going to be zero of that particular figure. That amount is gone. Now, we can also see in our balance sheet that our bank has correspondingly been increased in the name of that particular transaction. So you can see that that amount has been debited to our bank. What literally happened is that we have credited the accounts receivable and debited our bank to increase our asset. Simple as that. So that is the flow that we have just discussed, right from the procurement to payment and then to the sales concept. So in the end, um, you see what happens. You credit the revenue income account and then you debit your bank account. And then similarly, at the point of purchase, we also see the debit of the expense cost of goods sold and then credit bank alike. That is when you are paying the supplier. And this is what happens when you are receiving payment of services or sale of goods from your customers. So these transactions or these reports finally hitting profit and loss. So if you check your P&L, you will see that your revenue has increased accordingly. So if you check your revenue account for the sales, you will see that the sales account has been updated for that particular amount of money that you sold the goods. Revenue by default is credited, and this is exactly how it's going to look like. So if you follow these procedures and protocol, you are going to be able to successfully deliver the process flow for Odoo stock accounting. Let me know what you think in the comment section. If you have any difficulty, just put it in the comment section and we'll all respond to it. Enjoy, dear Odooers.